Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing PFB Corporation stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. PFB manufactures insulating products that enable residential and commercial structures to be highly energy efficient. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1968. It went public in 1995 and currently trades on the TSX and OTC. The ticker on the OTC is PGBOF. The company's expertise is in expanded polystyrene foams, EPS. They're the only vertically integrated EPS company in North America. EPS is styrofoam. Let's get started with the model. This is a micro cap company, 147 million market cap. They're trading at $21.65 a share, and they have 7 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has nice and growing free cash flow each year, up to 22 million in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that also grows quite a bit, from 2 million up to 15 million. Revenue is the sales for the company, and that grows each year from 106 million to 135 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. And their gross profit doubled from 2017, from 21 million to 41 million. Then below that is operating expenses, then operating income. And their operating income grows nicely each year, from 3.5 million to 20 million. Below that is the interest they pay in their debt, and that's at 1.1 million. Below that is other income and expenses, then pre-tax income, then their taxes. And the bottom line of the income statement is their net income. And this company is doing a good job at growing their net income each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Operating cash flow is a better indicator of a company's financial health than net income, because net income is your accounting profit and loss. Operating cash flow is actual cash that came in the door. They're also doing a good job at growing their operating cash flow. It tripled from 2017 to the trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. It looks like in 2017 they invested a lot in CapEx, 20 million. Not as much the following years. Operating cash flow minus CapEx gives you your free cash flow. They did have negative free cash flow in 2017, but positive each year after. They seem to be reducing the amount of debt they have each year, paying it down a little bit each time. Let's look at the capital structure. $66 million of equity, $17 million of debt. They're 79% equity, 21% debt. Their net debt is negative 12 million. That means they can use the cash on their balance sheet to pay down all their debt and still have $12 million of cash left over. Their WACC is 7.75%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 674 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $590 million. We divide that by 7 million shares, and we get a calculated stock price of $87. They're trading at $22, so they're trading at a 75% discount. It's a really strong buy according to the model. Simply Wall Street values the company at $55. They're also saying the stock is undervalued. Just because a stock is undervalued doesn't mean the stock price will go up. The only way the stock price goes up is when demand for the stock is greater than supply. When more people buy the stock than sell it, it pushes the price higher. And there's a lot of stocks out there, especially microcap stocks, that don't get much attention, so they're not being purchased. Investors keep buying some stocks that are losing money because of all the hype around the stocks. This stock is probably not going to get any hype, so you might have to wait a long time for investors to realize that there's a value here. This is the stock price the last 5 years, and it was pretty flat for a while. The stock has doubled in the past few months, so maybe investors are realizing there's a great value here. And this company pays a quarterly dividend 1.85%. They pay out 18% of their net income and 13% of their free cash flow. They have a really low beta, 0.39, so the stock moves much less than the market. It's not volatile at all. The stock has gone up 95% in the past 52 weeks, while the S&P 500 went up 40%. The 52-week low was $8, the high was $24. And the stock is trading below its 50-day, but above its 200-day moving average. About 2,000 to 6,000 shares are traded each day on this stock. Of the 6.8 million shares outstanding, 3 million are on float, 5% are held by institutions. Almost none of the shares are shorted. Their biggest shareholder owns 39% of the stock. Then Kernwood owns 14%, Pender Fund owns 4%, Pembroke, then William Smith, who's part of the company. Let's look at their financial ratios. The average PE in the market's 8.8, the median is 13.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 9.7, so investors are paying $9.70 for $1 of earnings. Price of sales is stock price over sales per share. They're at 1.1. That's a really good price to sales ratio. Price to book is stock price over book value per share. They're at 2.2. Also another good ratio. And the way you calculate book value per share is equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 66 million of equity. 62 million of tangible equity, since they have 4 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They have a great ROE at 23%. Current ratio is current assets over current liabilities. They can easily cover their current liabilities. And their current assets are 29 million of cash, 15 million of receivables, and 11 million of inventory. So the company does seem to be well capitalized. They had $22 million of free cash flow, 36 million of working capital, and a $3 million dividend payment. So they have $55 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 3 companies in the same industry as PFB, and if PFB has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're worse than average in PE because one company has a big negative, which is dragging down the average, but they do have a good PE. They're doing better on price of sales, price to book, current ratio. They're doing great in ROE. They have the lowest amount of debt, but they're the smallest company by far, and they do pay the biggest dividend. So to summarize, I have them trading at a 75% discount, and this stock has gone up a lot the past few weeks. So maybe the market is finally realizing the value this company has. It's doing a great job at growing its business, it's profitable, but it's really small. That's always risky when you invest in a small company. But they might get acquired, and you could make a nice return if you own the stock and they get acquired. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.